$121.67. That was silver's price on January 29, 2026, a brand new all-time record in the history of this metal. And I want you to sit with that number for a second. $121.67 per ounce. Less than 30 days later, here we are today, March 9th, 2026, and silver is sitting at around $83. That's a swing of nearly $40 per ounce in under 5 weeks, nearly a 32% collapse from the peak. And if you're sitting there thinking that's just normal market volatility, I need you to stay with me for the next 20 minutes, because what I'm about to walk you through is not normal. It has a very specific cause, a very specific mechanism, and a very specific historical fingerprint that has shown up twice before in this exact metal, once in 1980 and once in 2011. Both times, people who understood what was happening came out the other side positioned correctly. The people who didn't understand it panicked and sold at the bottom. I'm going to make sure you're not in that second group. Let me give you the full picture first, because the news cycle has been covering this story from about 3 inches away, when it really needs to be viewed from 30,000 feet. Silver started 2025 at approximately $30 an ounce. Over the course of 12 months, it climbed more than 279%, driven by a combination of industrial demand, supply deficits, China's export restrictions, and a global flight to hard assets as the dollar weakened. By late January 2026, silver hit that record of $121.67, and the whole world was paying attention. Retail investors were piling in. Indian and Chinese buyers were draining physical inventory at a pace nobody had seen in years. And then, seemingly overnight, the CME group, that's the Chicago Mercantile Exchange, the entity that controls the COMEX futures exchange where paper silver is bought and sold, pulled a lever. They raised margin requirements on COMEX 5,000-ounce silver futures contracts from 15% to 18%. According to official CME clearing advisories, that change was effective after the close on February 6, 2026. And it wasn't the first time. According to documents from CME Group, they had raised silver margins multiple times in rapid succession, first on December 12, 2025, raising them by 10%, then again on December 29, 2025, then on January 30, 2026, and then again on February 6th. Multiple margin hikes in the span of roughly 7 weeks. And if you don't know what a margin hike does to a leveraged futures market, buckle up, because this is the part that explains everything. Quick message for anyone who isn't subscribed yet. My analytics tell me about 3 out of 4 people watching right now haven't hit that subscribe button. If this kind of deep dive analysis is helping you cut through the noise and actually understand what's happening in these markets, subscribing is literally the only signal that tells me the community is here and engaged. It takes 2 seconds. It helps the algorithm push this to more people who need to see it. Now let's get back into this. Here's how margin requirements work in a futures market, because this is the engine that drove everything. When you buy a silver futures contract on the COMEX, you don't pay the full value of the contract up front. Each contract represents 5,000 ounces of silver. At $121 per ounce, that's a contract worth over $600,000 in silver. But you don't need $600,000 to control it. You need a margin, a percentage of the total value posted as collateral. At 15% on a $121 silver contract worth $605,000, your margin requirement is around $90,750 per contract. When CME raised the requirement to 18%, that same contract now required $108,900 in posted collateral. That's roughly $18,000 more cash per contract, overnight with no warning. Now imagine you're a hedge fund holding 500 contracts. You just got a bill for $9 million due immediately, and if you can't pay it, your broker force sells your position. You don't get a choice. And when thousands of leveraged traders across the market all get hit with the same margin call at the same time, they all sell simultaneously into the same market. That waterfall of forced selling is exactly what sent silver from $121 down to roughly $64 in the week after the February 6th hike. 47% wiped out in days. Not because anyone decided silver was worth less, not because industrial demand collapsed, not because a mine opened up and flooded the market with new supply, because the exchange changed the rules of leverage mid-game, and thousands of traders had to sell whether they wanted to or not. The goldsilver.com team described this perfectly when they noted the hike triggered forced liquidations, a mechanical event, not a fundamental one. And according to a detailed analysis from discoveryalert.com.au, CME framed each of these hikes as routine risk management tied to market volatility. That's the official language. What it really means is the exchange was spooked by what was happening and decided to slow it down the only way they could. Now here's where it gets truly alarming, and I want you to hear this clearly because this is the part of the story that most coverage is completely skipping. These margin hikes are not new. This exact playbook has been run twice before in silver's history, and both times it marked a sharp but temporary interruption of a larger, longer bull market. Let me take you back to January 1980. Silver had been on an extraordinary run. The Hunt brothers, Texas oil billionaires Nelson and William Hunt, had spent nearly a decade accumulating physical silver and silver futures, driving the price from about $1.50 per ounce in 1971 to a peak of $49.45 per ounce on January 17, 1980. That was a gain of more than 3,000%. Retail investors were flooding in, mints were overwhelmed, and the public was frantic. The COMEX's response? They introduced what's now known as Silver Rule 7, a regulatory intervention that restricted silver purchases and dramatically raised margin requirements. The price collapsed. From $49.45, silver plunged to around $10 per ounce by March. A collapse of nearly 80% in under 2 months. The Hunt brothers were ruined. But here's what the textbooks don't emphasize. Silver never went back to $1.50. It never even got back to $5. The post-crisis floor was roughly 3 to 4 times the pre-rally starting point. The margin hike didn't end silver. It ended the speculation and reset the floor at a permanently higher level. Then, 2011. Silver had ridden the wave of the 2008 financial crisis and its aftermath. The Fed's quantitative easing, inflation fears, and a weak dollar pushed it from about $8.88 per ounce in late 2008 to a peak of $48.70 in April 2011. Another extraordinary run. And the CME's response? Same playbook. According to APMEX's documented market history, the exchange instituted tighter margin requirements, making it more difficult to speculate in silver with margin. The price collapsed from $48.70 to below $30 within weeks. But again, silver never went back to $9. The new floor was roughly $15 to $20, 3 times the pre-rally base. 2 cycles, same pattern. Margin hike, sharp crash, permanent price reset at a higher floor. And now, in 2026, we're watching it happen a third time. Let me walk you through the specific numbers of what's happened this cycle, because the scale of it puts everything into sharp focus. According to Visual Capitalist's detailed analysis, silver began 2025 at approximately $30 per ounce. It climbed relentlessly, driven by China's tighter controls on silver exports, escalating geopolitical tensions, industrial demand from solar and EVs, and investor panic buying. By January 29, 2026, it hit $121.67. That's a gain of more than 300% in roughly 13 months. The CME raised margins multiple times. The crash came. Silver hit a low of approximately $63 to $64 in early February. Then it bounced. By February 27, 2026, Fortune was reporting silver back at $92.06 per ounce. By March 2nd, it was $94.26. By March 4th, $85.69. By March 5th, $82.78. And today, as of early March 9, 2026, silver is trading in the low to mid $83 range. So we've seen the crash, we've seen the bounce, and now we're seeing a second leg of consolidation and correction. And if you know the 1980 and 2011 patterns, this is almost textbook. The question is where the new floor sets. Now let me pile on the evidence, because the price action is only part of the story. The physical market tells a completely different story than the paper market does, and this is where things get truly fascinating. Let me give you the COMEX inventory numbers. According to data reported by Samco Securities and independently analyzed on the investing platform at jinlo.substack.com, COMEX registered silver inventory, that's the metal physically on hand and available for delivery, fell below 90 million ounces in February 2026. Total inventory is down nearly 31% since October 2025 alone. Think about that. The exchange where the world's paper silver contracts are traded and where delivery is supposed to happen has seen nearly a third of its registered inventory vanish in less than 5 months. Now here's the math that should concern everyone. According to the detailed March 2026 COMEX delivery analysis, the March 2026 futures contract at first notice day had approximately 10,526 contracts standing for delivery. That's 52.63 million ounces of silver that holders are demanding to take physical possession of, against a registered inventory of just 86.13 million ounces. And that's before you factor in that the total open interest in the March 2026 contract was somewhere between 85,000 and 91,000 contracts at various points, representing a theoretical obligation of 425 to 455 million ounces, against 86 million ounces of registered metal. You don't need a finance degree to see the problem there. Now let me take you to Shanghai, because the Eastern physical market is telling a story that directly contradicts what the COMEX paper price is saying. According to reporting from Anvest and cross-referenced by multiple analyst sources, Shanghai physical silver was trading at premiums of more than $10 per ounce above COMEX spot prices in February 2026. In late December 2025, physical bullion dealers in certain markets were reportedly trading at premiums that reflected the scarcity of available metal. The Shanghai Gold Exchange inventory fell to its lowest level since 2015 as of early February 2026, according to data cited in the COMEX delivery analysis. According to data compiled by FX Street and Trading Key, Shanghai inventory declined from 559 tons in November 2025 to just 318.5 tons by February 2026, a drop of 43% in roughly 3 months. Think of it this way. The paper market in New York is printing one price, and the physical market in Shanghai, where industrial buyers are actually trying to take delivery, is showing a completely different reality. When those two prices diverge that dramatically, one of them is not reflecting reality, and history suggests the physical market is the one telling the truth. Paper can be printed, metal cannot. Here's what makes this truly alarming when you zoom out to the structural supply picture. According to an in-depth FX Street analysis, the global silver market has been running in supply deficit for 5 consecutive years, 5 years in a row. In 2025, global silver demand reached an estimated 1.24 billion ounces, while total supply including mining and recycling only amounted to about 1.01 billion ounces. That's a deficit of over 230 million ounces in a single year, equivalent to the entire annual output of Mexico, the world's largest silver producer. And here's the structural kicker. According to JP Morgan Global Research, whose analysts laid this out in remarkable detail, roughly 75 to 80% of silver comes as a byproduct of mining other metals: copper, zinc, lead, and gold. That means even if silver prices doubled again tomorrow, miners cannot simply open new silver mines to increase supply. Their operations are driven by base metal economics, not silver economics. New mining projects take 8 to 12 years to develop, and ore grades globally are declining. The supply side of this equation is essentially fixed in the short to medium term, no matter what the price does. Let me add the demand side on top of that, because it only intensifies the picture. JP Morgan's metals team noted that in just the solar panel industry alone, silver demand grew from roughly 80 million ounces in 2016 to approximately 200 million ounces annually more recently. That's a 150% increase from one single industrial application. Add to that electric vehicles, AI server hardware, 5G infrastructure, and medical devices. At today's elevated price levels, above $100 at the peak, JP Morgan's analysts flagged that silver as a percentage of solar panel costs has gone from under 5% historically to over 30%, which creates an economic pressure to find substitutes. But as they also noted, those substitution processes take time. They don't happen overnight, and they don't happen during a supply crunch. The Sprott Physical Silver Trust made a notable move in January 2026 when it doubled its at-the-market equity program to $2 billion, up from $1 billion announced in December 2025. At $110 silver per ounce at the time, that $2 billion program could absorb approximately 18 million ounces of physical silver, representing roughly 16% of all remaining COMEX registered inventory. When an institutional fund of that size is doubling its commitment to physical silver accumulation, you need to ask yourself what they know that the mainstream financial press isn't telling you. Now I want to talk about the smoking gun element of this story, the piece that ties the CME's margin actions to a pattern that goes well beyond routine risk management. Look at the timing. The first silver margin hike came December 12, 2025, just as silver was breaking above $60 for the first time. Another hike December 29, 2025. Another January 30th, 2026, the day after silver hit its all-time record. According to the official CME clearing advisory from January 30th, 2026, a document you can look up yourself at cmegroup.com, the COMEX 5000 silver futures initial margin was raised to 15% across multiple contract months simultaneously. Then February 6th, another hike to 18%. 4 margin increases in roughly 8 weeks. According to the investinglive.com reporting on February 5th, 2026, CME justified the move citing extreme, fast price swings and forced deleveraging as the key theme. The Seeking Alpha analysis from January 5th, 2026 described it as a 30% increase in margin requirements, triggering forced liquidations, and a 17% price drop in a single session. CME framed each move as routine. And here's where the pattern recognition kicks in. These margin hikes always happen when silver is rallying hardest, never when it's collapsing. In 1980, margins were raised at the peak. In 2011, margins were raised at the peak. In 2026, margins were raised at the peak. The net effect every single time is to remove the speculative hot money from the market through forced selling, which temporarily crashes the price, scares retail investors into selling, and creates a window where the price is artificially depressed relative to the underlying physical fundamentals. That's not a conspiracy theory. That's a documented, repeating, 3-instance historical pattern. Let's talk about the disconnect more directly, because this is where the story gets personal for anyone holding silver right now. According to the goldsilver.com analysis, margin hikes create mechanical, short-term selling due to leverage reduction, but they do not change supply and demand fundamentals. The physical supply deficit is still 230 million ounces per year. COMEX inventory is still down 31% since October. Shanghai inventory is still down 43% since November. China's export restrictions that went into effect January 1, 2026, haven't been reversed. The U.S. has still designated silver a critical mineral. J.P. Morgan still forecasts an $81 per ounce average for all of 2026, which, given where we are today in the $83 range, is actually conservative relative to the structural case. The Reuters consensus forecast, gathered from an early February 2026 poll of analysts, placed the 2026 annual average around $79.50. We're already trading above both of those numbers in early March. The paper market crashed over to $63 in early February. The physical market never followed. Premiums stayed elevated. Dealers stayed tight on inventory. Shanghai stayed above COMEX. The screen said one thing, the vaults said another. And in any conflict between a screen number and an empty shelf, the empty shelf wins eventually. Here's what I need you to understand about JP Morgan specifically, because their role in this market is not incidental. According to the COMEX delivery analysis published by jinlo.substack.com, JP Morgan issued 99% of 8.1 million ounces in delivery notices through 1,624 contracts during the first week of January 2026. That's an institution taking delivery of physical silver aggressively, standing for delivery rather than rolling contracts or settling in cash. The same institution that has historically been one of the largest short sellers in paper silver markets is simultaneously demanding physical delivery at an extraordinary rate. And February 2026, according to the same analysis, saw 5,036 contracts physically delivered, the highest February delivery volume in modern COMEX history. Not paper settlement, not cash settlement, actual physical silver changing hands. If the price was truly reflecting the fair value of silver, why would the most sophisticated financial institutions in the world be lining up to take delivery of the physical metal at this pace? They know something the retail price chart doesn't tell you. So what does all of this mean for you practically? Let me be very direct about this, and I want to be clear that nothing I say here is financial advice. I'm not a financial advisor, and every decision you make needs to be based on your own research and your own circumstances. I'm showing you data and historical patterns, not prescriptions. With that said, here's what the evidence tells us about what's happening right now. First, the crash from $121.67 to around $63 was driven by a mechanical, margin-forced liquidation event, not by any change in the physical supply and demand picture. The fundamentals that drove silver to $121 are still intact. Second, we are now in a consolidation and recovery phase. Silver bounced from $63 back to $94 by early March, before pulling back again into the $83 range as of today. This consolidation pattern, a sharp crash, a bounce, a secondary pullback to build a new base, appeared in both 1980 and 2011. Third, if the historical pattern holds, the new price floor after this consolidation will be materially higher than where silver was before the speculative run began. Before the 2025 rally started, silver was around $29 to $30. A floor at 3 to 4 times that level, which is what history suggests, would put it in the $90 to $120 range. We haven't conclusively found that floor yet. Fourth, the COMEX delivery situation for March 2026 is genuinely extraordinary. 52.63 million ounces standing for delivery against 86 million ounces of registered inventory is a ratio that has never existed in this market before at this scale. If even a fraction more of those contract holders demand delivery and the exchange cannot produce the metal, the ramifications for the paper price discovery system are significant. Fifth, watch the Shanghai premium. If it continues to hold above Western COMEX prices, that confirms the physical scarcity narrative. If it narrows, that suggests some relief in physical supply tightness. Sixth, watch CME for any additional margin changes. Another hike could create another forced selling wave. A reduction in margins, which typically happens as volatility normalizes, would be a catalyst for renewed upward momentum. And seventh, understand the difference between paper silver, ETFs like SLV, futures contracts, leveraged positions, and physical silver in your possession. The margin hike mechanism only affects paper. Physical silver sitting in your hands cannot be margin called. Let me bring this full circle because I want to leave you with the clearest possible framework for what just happened and what comes next. On January 29, 2026, silver hit $121.67 per ounce, its first all-time nominal record in 45 years. The CME raised margin requirements 4 times in roughly 8 weeks, consistent with what they did in 1980 and 2011. Forced liquidations drove silver from $121 to $63, one of the most violent short-term corrections in commodity market history. The physical supply deficit didn't change. The inventory depletion didn't change. The structural industrial demand from solar, EVs, AI, and 5G didn't change. China's export restrictions didn't change. And today, roughly 6 weeks after the crash, silver is trading around $83, still more than 150% above where it started 2025, and still in a market where COMEX registered inventory is at levels that haven't been this tight in years, where Shanghai is pulling metal at an unprecedented pace, and where some of the most sophisticated institutional buyers on the planet are standing for physical delivery rather than rolling their paper contracts. I've shown you the documented data. I've shown you the CME filings. I've shown you the historical pattern from 1980 and 2011. I've shown you the physical versus paper divergence. What the people in 1980 and 2011 who lost money had in common is that they didn't understand that a margin-forced liquidation is not the same as a fundamental change in the value of the underlying asset. They saw the price fall and assumed it meant the story was over. It wasn't over in 1980. It wasn't over in 2011. And based on everything documented in this video, the structural case for silver has not fundamentally changed today. The only question, as it always is in markets, is whether you understand what's happening well enough to stay calm while others are panicking. The people who understood Silver Rule 7 in 1980 bought the dip and held. The people who understood the 2011 margin hikes bought the dip and held. Both groups did well on a long enough timeline. The people who panicked and sold at the bottom, they locked in losses that didn't need to happen. I'm not here to tell you what to do with your money, but I am here to make sure you have the full picture that the mainstream financial press isn't giving you. Because when someone tells you silver crashed because of, quote, market volatility, they're technically correct and fundamentally misleading you at the same time. The volatility had a cause, the cause had a name, the cause had a precedent, and the precedent has a pattern. Now you know the pattern. Drop a comment below and tell me this. Do you think the $63 low in early February was the bottom of this correction cycle? Or do you think we see another leg down before silver finds its new structural floor? I read every single comment. The community's collective intelligence on this is always better than any single analyst, and your perspective genuinely shapes what I cover next. If you want to go deeper on the physical delivery situation at COMEX and exactly what happens if March 2026 delivery demands exceed registered inventory, that breakdown is coming in the next video. Make sure you're subscribed and have notifications on so you don't miss it. The data on this next piece is genuinely unlike anything I've covered before. I'll see you there.